I can't quite understand this, but someone pointed this out to me. This graph shows that the situation with bonds is the same now as it was when we had the catastrophe of Liz Truss breaking the economy. This hasn't been reported. As far I've looked at all the papers today, it's not reported in there. So, can you tell us what this means?
Well, yes, as you rightly say, the pattern is very similar to the time of Liz Truss and Kwasi Kwarteng. Now, let me just explain what this yield and how it is worked out. So the yield is based on perceptions of the future. So what the markets think is that the government's inflation reduction policy is not very effective. And if anything, inflation will be reduced very slowly, and higher interest rates are here to stay and may well be there for quite some time. So how is that graph constructed? So here's a very simple example. Suppose the government issues a 20-year bond offering investors 1% return. What that means is anyone holding that bond would receive £1 interest each year and £100 on maturity in 20 years. But meanwhile, if inflation is out of control or the government policies don't make any sense, let us now imagine investors want a 5% return. So what that means is that the bond, which has £100 written on it, will now need to sell for £20. So the recipient of that bond will receive £1 interest each year, which is equivalent to 5% return because they paid £20. Of course, in reality, the price would be more than 20 because the holder of the bond will also get the maturity eventually. So the rising yields reduce the value of the gilts, and that is actually disastrous for pension funds and others. And you remember what happened after the Kwarteng budget, when the market yields rocketed and most of the pension funds were bust. The worst thing this time is that the government itself is creating the turmoil. Now, we all remember how government issued nearly £1 trillion of quantitative easing, and with that, it ended up propping the capital markets by buying corporate bonds and the government gilts. So it's holding at the moment of those securities, it's an enormous number, £836 billion of gilts it had bought and £13 billion of corporate bonds. Now that obviously made many speculators very rich because worthless corporate bonds suddenly became more valuable. Now the government is actually selling those bonds. And earlier this year, it came to light that the government was planning to sell them at a loss, and the total loss would be about £200 billion. I repeat, £200 billion, which people will have to pay because the government is selling these bonds at a loss. So in the first quarter of this year, it has sold £19.3 billion of gilts and £5.8 billion of corporate bonds. Now, when you flood the market with such vast value of gilts, one thing you do is you depress the price of the gilts. And that is another reason why the yield would increase. In other words, people are saying, hang on, what's going on here? So the government itself is now making it harder for companies to raise funds. Its policies would mean higher mortgage interest payments, higher rents for people, and many SMEs would be clobbered because they rely on bank loans and overdrafts for their working capital. So why is the government doing this, as you said? Well, it's hard to see any economic logic in this whatsoever. It is possibly using higher interest rates to enrich the city. Bank profits will certainly increase every time you increase the interest rates. Their executive bonuses would increase and the dividends would increase. Maybe the government wants to attract footloose money to the City of London, but for what purpose? Because we don't seem to be investing much in our economy. And I think really the real reason is that the higher interest rates can be used to discipline the working class, to say, okay, you're poor, you remain poor. You can't rely on bank loans and overdrafts to help you out. So in a sense, the policy is being used to impoverish the working class and discipline the working class. And the fourth major reason, in my view, is that they're leaving a poison pill for the next government, which could well be the Labour government, to say, okay, you manage the consequences of higher inflation, higher interest rates, and an economy which is lacking investment. And thus, they will be able to point the finger at the next government and say, look, it's not really managing the economy very well. So that is sort of my reading of that graph that you put up.
Well, just to ask, why do you think the media is not covering it? I mean, why the media was all over the Liz Truss stuff? Was there an agenda, do you think, from the media to get rid of Truss, but they're not interested in getting rid of Sunak, or they just want to keep things as it is?
It could be a combination of all those factors, but I think the media has been far more obsessed with what Boris Johnson's been up to and that kind of thing, rather than looking at a real kind of crisis which is bubbling away under the surface, really. And I think, also there are serious questions about the Bank of England's so-called inflation control policy. I mean, it is selling government bonds at a loss. How can that keep the interest rates down, and higher interest rates just enrich bankers? So I think it is really failed economic policy, but media may well have an agenda. But I think it also poses questions about the Labour Party, because the Labour Party is, in a sense, committed to more or less the same policies as the Conservative Party.